It's normal to feel a little uneasy when you hear about job losses or rising unemployment. So today, let's talk about the slowing job market and what it means for the economy and your portfolio. In February 2026, total non-farm payrolls fell by about 92,000 jobs. That's the weakest reading since last October. And when you zoom out a bit, the average job gain over the past year has been only about 19,000 per month, a big slowdown compared with earlier years of strong growth. On top of that, the last 2 months of payroll numbers were revised down by 69,000 jobs, which reinforces the trend that the labor market has been cooling more meaningfully than many expected. The unemployment rate did rise, but just slightly, from 4.3% to 4.4%. Nothing dramatic there on its own, but there is an important shift happening beneath the surface. Currently, the number of unemployed people, about 7.6 million, is actually higher than the number of job openings at around 6.5 million. For several years, it was the exact opposite. There were far more open jobs than workers available. This flip tells us the job market really is slowing. It's not all bad news. Before you start picturing a recession, let's talk about some of the bright spots. One of the biggest positives in this report is wages. Average hourly earnings rose about 0.4% in February, and they're up 3.8% over the past year. That's actually faster than inflation, and that's a big win for workers and consumer spending. When people have more real purchasing power, it helps support the economy. The Fed has been responding to this softer labor market for a while now. In late 2025, they cut interest rates 3 times, bringing the target rate down to 3.5 to 3.75% range. Historically, lower interest rates are generally supportive for both stocks and bonds because they reduce borrowing costs and stimulate economic activity. But now the Fed is juggling 2 competing forces: a weakening job market and potential inflation pressures because of higher oil prices. They're balancing carefully, not wanting to slow the economy too much, but also not wanting inflation to flare back up. Other parts of the economy are still showing strength. Even with a softer job market, not everything points towards weakness. Corporate earnings, for example, have remained solid. Over the past 12 months, S&P 500 earnings have grown 13.2%, well above the long-term average of about 7.7%. That's a sign that businesses overall are still healthy and profitable. Manufacturing and services, the backbone of day-to-day economic activity, have also shown improvement recently. And job cuts outside the payroll numbers have dropped back to more normal levels. So while the labor market is slowing, other parts of the economy are still moving in a positive direction. If we look at the labor market over the last several years, you'd see a major boom followed by a plateau. And that makes sense. After years of rapid hiring, some leveling off is normal and even expected. Short-term numbers can sometimes feel alarming, but investors who stay disciplined and focused on longer-term trends like earnings growth and the direction of interest rates tend to fare far better than those who react to a single economic release. So yes, the job market is cooling, but wages are rising, businesses are still earning, and other economic signals remain steady. As always, your long-term plan is built to weather these shifts. If you have questions or want to talk through how this fits into your own financial strategy, feel free to reach out anytime.